Hello, here from Anchorage, Alaska, Lorrie Seward Realty and Joe with Homeowners Financial Group. How are you, Joe?
I'm doing pretty good. We are here today to talk about credit.
Yes,
So I understand that you might have some questions.
I do. A lot of people have credit karma and it comes up with a certain credit score. So, what is the difference between a credit karma credit score and a credit score for a mortgage loan?
Good question. I get this one a lot, actually. So with Credit Karma, you're going to get a consumer credit report versus for mortgage, we need a tri-merge credit report that's specifically designed for mortgage. It pulls Equifax, Experian, and TransUnion, and we throw away the top score, the bottom score, we don't average, and we use the middle score for the mortgage. That's just how it's done. If there's multiple people on the loan, it's the same process, but whoever's got the lower of the two borrowers, middle score is the score for the loan, for qualifying, for all the stuff.
Now, is there different types of credit scores within, like what makes up a credit score?
The algorithm is consistently changing, but for the most part, where we're currently at with the mortgage credit report, the length that they've had credit or a trade line, such as a car or a house or a credit card, average age of account typically makes up about 15% of their credit score, such as like if you have an installment versus a revolving versus a house payment. If you have a little bit of diversity, that makes up about 10%. New credit is one of the things that can hurt people at times. And until, say, you buy a car, for the first 6 months of making payments on time, it doesn't help you. Frequently it hurts you. And after that first 6 months, then it's not considered new credit, and your score starts to recover. But the biggest factor, I think, is payment history and available credit. Making on-time payments for a long time. And on-time is not 30 days late. I mean, if you pay 18 days late, it doesn't affect your credit score in any way. You still paid. You may get a late fee,
Right.
but that doesn't mean that it's going to hurt your credit. But the last piece is really the available credit that you have. That's 25 to 30% of your score right there, which that's a big number. And say you have a $10,000 limit on your credit card and you have $9,000 charged on it, you're almost maxed out. That hurts your score. Once you have it below a 50% of available, it's kind of neutral. It doesn't help or hurt. Once you're below 30%, it starts helping a good amount, and below 10%, it's really helping. But the good news with that, there's little tricks to it. You can you can be added to someone else's card that's got a good history and a low balance, and you can get credit for their good history.
So you mean like an authorized
Yeah,
user?
exactly.
Okay.
Like I saw a person add to their mom's account. They were 22 years old. Mom had a credit card for like 25 years and added him as an authorized user, and he got that entire history, and it 80 points or something like that. It raised his score. It was great. Just be careful you don't do it with American Express, because the average age of accounts won't work that way, it'll hurt that piece.
Oh, interesting. Okay.
Yeah, because
No American Express.
yeah, I mean, it'll work as an additional trade line or a type of credit, but the length of credit will sabotage you because they'll not give the history. It'll be day one, and so it's new credit at that point.
Gotcha. If someone were to apply for a mortgage loan or approval, how many points does that typically take off of their credit score? And how long does it take for those points to come back up?
Good question. The higher the credit score, typically the less the inquiry hurts the score. I've seen it before where you have an 800 credit score and you do a hard inquiry and it drops 2 or 3 points off. But I've also seen where there's a 580 credit score and it can drop 10 to 15 points off.
Ooh.
Which is significant. Typically, the further away from the inquiry, such as 2, 3, 4, or 5 months, it has less and less effect. And usually there's no effect from the inquiry once you get to about 12 months. I believe it stays on the credit report for, I want to say, 2 years, but it goes away in terms of detrimental effect pretty quickly.
Once you apply for a mortgage and it takes points away, how do they get, like, it takes 12 months to get those points back, or?
No, say it took 10 points away, and after 3 months, if you did a soft pull or you did something like that that didn't re-hurt by looking at it, you probably got, of those 10 points, you probably got 2 or 3 points back. And then a couple months later, you probably got another few points back.
Okay.
It's interesting in the algorithm that does dictate is constantly changing.
Okay, well, thank you so much for talking about credit scores.
Exciting
and
stuff.
Providing value to everybody who's questioning about that. I will put Joe's information in the comments below, and thank you.
Thank you.